Good day, everyone. We are Group 4 and we are going to present the second part of Chapter 2, Return Concepts. I'm Chooi Yin and my group members are Yuen Lee, Man Ning, Joanne, Kim Foong, and Jessica. Next, I will pass it to Kim Foong.
I am Kim Foong. I will present the required return on equity. With means to estimate the equity risk premium in hand, the analyst can estimate the required return on the equity of a particular issuer. The choices include the following: the capital asset pricing model, a multi-factor model such as the pharma, French, or related models, and a build-up method such as the bond yield plus risk premium method. Firstly, let's look at the capital asset pricing model. Capital asset pricing model is an equation for required return that should hold in equilibrium if the model's assumptions are met. Among the key assumptions are that investors are risk-averse and that they make investment decisions based on the mean return and variance of return of their total portfolio. The chief insight of the model is that investors evaluate the risk of an asset in terms of the asset's contributions to the systematic risk of their total portfolio. Capital asset pricing model provides an economically grounded and relatively objective procedure for required return estimation, and it has been widely used in valuation. The formula of capital asset pricing model is as shown in the slide. For example, assume that the current expected risk-free return is 5%, the assets beta is 1.2, and the equity risk premium is 4.5%. Substitute the values into the equation and we can get the required return on share, which equals to 0.104 or 10.4%. The assets beta measure its market or systematic risk, which in theory is the sensitivity of its returns to the returns on the market portfolio of risky assets. Beta equals the covariance of returns with the returns on the market portfolio divided by the market portfolio's variance of returns. In typical practice for equity valuations, the market portfolio is represented by a broad value, weighted equity market index. The assets beta is estimated by a least squares regression of the assets return on the index returns and is available also from many vendors. 4.1.1 Beta estimations for a public company. The simplest estimate of beta results from an ordinary least square regression of the return on the stock on the return on the markets. The result is often called an unadjusted or raw historical beta. The actual values of beta estimates are influenced by several choices, such as the choice of the index used to represent the market portfolio, and the length of data period and the frequency of the observations. The beta value in a future period has been found to be on average closer to the mean value of 1, the beta of an average systematic risk security, than to the value of the raw beta. Because valuation is forward-looking, it is logical to adjust the raw beta so it more accurately predicts a future beta. The most commonly used adjustment was introduced by Bloom, 1971. Adjusted betas equals to 2 over 3 multiplied by unadjusted beta, then plus 1 over 3 multiplied by 1. For example, if the beta of an asset's return on the market return is 1.3, after substituting it into the equation, we get an adjusted beta of 1.2. Next, I will pass it to Joanne.
I am Joanne and I will present the example for calculating the required return on equity using a capital asset pricing model. Based on the information given, the required return on equity of ExxonMobil Corporation is 8.23%, while the PB, PLC, and total SA has a required return on equity of 9.1% and 9.03%. Next, when a share issue trades infrequently, the most recent transaction price may be stale and not reflect underlying change in value. When a monthly data series in which missing values are filled with the most recent transaction price, the estimated beta will be too small, and the required return on equity will be underestimated. 4.1.2 Beta estimation for thinly traded stock and non-public company. Analysts do not have to access to a series of market price observations for non-public company with which to calculate a regression estimated of beta. Instead, they use an industry classification system such as the MSCI or Standard & Poor's Global Industry Classification Standard or the Dow Jones FTSE Industry Classification Benchmark to identify publicly traded peer company and estimate indirectly the beta of non-public company on the basis of the public peers beta. There are several steps in estimating a beta for a non-traded company. Step 1, we need to select the benchmark. Step 2, we need to estimate the benchmark beta, then label the benchmark beta, and lastly, label the beta to reflect the subject company financial leverage. Let's take a look at the benchmark beta. If the depth of the benchmark is high quality, so an assumption that the depth beta is 0 should be approximately 2. Analysts can use the following expression for unleveraging the beta. On the other hand, if the subject company have the debt and equity level respectively, and assuming the subject company debt is high grade, the subject company equity beta is estimated as follows. Suppose that a benchmark company is identified and is 40% funded by debt. By construct, the weight of debt in the subject company capital structure is only 20%. The benchmark beta is estimated at 1.2. The 40% weight of debt in the benchmark implies that the weight of equity is 100% minus 40% equal to 60%. By using this information, we can unlever the benchmark beta and get a result of 0.72. The unlevered beta of 0.72 is relevered according to the financial leverage of the subject company, which use 20% debt and 80% equity. Then we can finally get the equity beta of the subject company, which is 0.9. Next is the example of calculating the required return on equity using the capital asset pricing model. Add terms to determining a beta for use in evaluating the offer of an equity stake in the private insurer and round a beta estimate of Allegheny, the public comparable to 0.5. As of the valuation that Allegheny Corporation has no debt in its capital structure, the private insurer is 20% funded by debt. If a beta of 0.5 is assumed for the comparable, what is the estimated beta of the private insurer? Because Allegheny does not use debt, its beta does not have to unlever. For the private insurer, if the debt is 20% of capital, then equity is 80% of capital and 20 over 80 equal to 0.25. Therefore, the estimate of private insurer equity beta is 1.25 times 0.5 equal to 0.63. The capital asset pricing model is a simple, widely accepted theory-based method of estimating the cost of equity. Beta, its measure of risk, is readily obtainable for a wide range of securities from a variety of sources and can be estimated easily when not available for a vendor. In portfolio, the idiosyncratic risks of individual securities tend to offset against each other, leaving largely beta market risk. For individual security, the idiosyncratic risk can overwhelm market risk, and in that case, beta may be a poor predictor for future average return. Thus, the analysts need to have multiple tools available. Next, I will pass it to Yuen Lee.
I'm Yuen Lee and I will present 4.2 multi-factor models. For many markets, evidence suggests that multiple factors drive returns. At the cost of greater complexity and expense, the analyst can consider a model for a required return based on multiple factors. Greater complexity does not ensure greater explanatory power. However, any selected multi-factor model should be examined for the value it is adding. While CAPM adds a single risk premium to the risk-free rate, arbitrage pricing theory (APT) models add a set of risk premia. APT models are based on multi-factor representation of the drivers of return. Formally, APT expressed the required return on an asset as follows. The factor sensitivity or factor beta is the asset sensitivity to a particular factor. Meanwhile, the factor risk premium for a factor is the expected return in excess of the risk-free rate occurring to an asset with unit sensitivity to factor and zero sensitivity all other factors. One of the best-known models based on multiple factors expands upon the CAPM with additional factors is the Fama-French model. The FFM is among the most widely known non-proprietary multi-factor models. The factors are as follows. The first factor is RMRF. It is the return on a market value weighted equity index in excess of the 1-month T-bill rate. The second factor is SMB, small minus big, which is a size factor. SMB is the average return on 3 small cap portfolios minus the average return on the 3 large cap portfolios. The third factor is HML, high minus low, which equals to the average return on 2 high book to market portfolios minus the average return on 2 low book to market portfolios. The formula of the FFM estimate of the required return is as shown in the slide. RMRF represents the market return minus risk-free return. SMB refers to the mean return to shorting large cap shares and investing the proceeds in small cap shares. And HML equals to the mean return from shorting low book-to-market shares and investing the proceeds in high book-to-market shares. For example, the short-term interest rate is 4.1%, RMRF is 5.5%, SML is 2.0%, and HML is 4.3%. Substitute all the information into the equation and we will get the estimate of FFM as shown in the slide. Assume that the market beta is 1.2. If the issue's market cap is small, we expect to have a positive size beta, for example 0.5. If the shares sell cheaply in relation to book equity, the value beta is also expected to be positive, for example 0.8. For both size and value betas, 0 is the neutral value, while for market beta, the neutral value is 1. Substituting all values into the equation, we can calculate the shares required return. There are two types of FFM factor. One is an equity market factor, which is identified with systematic risk as in the CAPM. The other types of factors are size and value, which are related to company characteristics and valuation. The FFM views the size and value factors as representing a set of underlying risk factors. It views the return premiums to small size and value as compensation for bearing types of systematic risk. However, many practitioners and researchers believe that those return premiums arise from market inefficiencies rather than compensation for systematic risk. Next, there have been extensions to the FFM. The thought process behind the FFM of extending the CAPM to capture observed patterns in equity returns, which differences in the CAPM beta appear not to explain, has been extended by other researchers. One well-established relationship is that investors demand a return premium for assets that are relatively illiquid. Pastor and Stenbaugh in 2003 extended the FFM to encompass compensation for the degree of liquidity of an equity investment. The Pastor-Stenbaugh model (PSM) adds to the FFM a fourth factor, LIQ, representing the excess return to a portfolio that invests the proceeds from shorting high liquidity stocks in a portfolio of low liquidity stocks. The PSM is as shown in the slide. An average liquidity would have a liquidity beta of 0 with no impact on required return. On the other hand, below average liquidity will have positive liquidity beta and it would increase the required return, while above average liquidity would have negative liquidity beta and would decrease the required return. Next, I will pass it to Man Ning.
I'm Man Ning and I will present 4.2.3 Macroeconomy and Statistical Multi-Factor Models. Models for required return have also been based on macroeconomy and statistical factors. In macroeconomy factor models, the factors are economic variables that affect the expected future cash flows of companies or the discount rate that is appropriate to determine their present values. In statistical factor models, statistical methods are applied to historical returns to determine portfolios of securities that explain those returns in various senses. A specific example of macroeconomic factor models is the 5-factor BIRR model. The definition of the 5 factors are as follows. Confidence risk. Confidence risk is the unanticipated change in the return difference between risky corporate bonds and government bonds, both with maturities of 20 years. To expand the factors name, when their confidence is high, investors are willing to accept a smaller rewards for bearing the added risk of corporate bonds. Time horizon risk. It is the unanticipated change in the return difference between 20 years government bonds and 30-day treasury bills. This factor reflects investor willingness to invest for the long term. Inflation risk. It refers to the unexpected change in the inflation rate. Nearly all stocks have negative exposure to this factor as their return decline with positive surprises in inflation. As for business cycle risk, it is the unexpected change in the level of real business activity. A positive surprise or anticipated change indicates that the expected growth rate of the economy measured in constant dollar has increased. Lastly, market timing risk refer to the portion of the total return of an equity market proceeds such as the S&P 500 for the United States that remain unexpected by the first 4 risk factors. Almost all stocks have positive sensitivity to this factor. The fifth factor acknowledges the uncertainty surrounding the correct set of underlying variables for asset pricing. This factor captures influence on the returns to the market proceeds not explained by the first 4 factors. For example, using such a model, the required return for a security could have the following form. Next, I will pass it to Jessica.
Hi, I'm Jessica and I will present on 4.3, which is the build-up method estimate of the required return on equity. Widely used by evaluators of closely held business, the build-up method estimates the required return on an equity investment as the sum of risk-free rate and a set of risk premia. The build-up method parallels the risk premium approach embodied in multi-factor models, with the difference that specific beta adjustments are not applied to factor risk premium. Next, 4.3.1, which is regarding the build-up approaches for private business valuations. The need for estimate of the required return on the equity of a private business arises when present value models, which is also known as the income model, are used in the process of valuing business interests. Some standard approach to estimate the required return on equity such as CAPM and FFN are adaptable for estimating the required rate of return for private business. However, evaluators often use an approach which relies on building up the required rate of return as a set of premia added to the risk-free rate. For the premia, it usually includes the equity risk premium and one or more additional premia which based on factors such as size and perceived company-specific risk. For private business valuation, there are 2 methods that can be used to estimate the required return on equity. First, the required return on equity can be estimated as the sum of risk-free rate, equity risk premium, and specific company premium. Besides, it can also be estimated by the sum of risk-free rate and beta multiplying with the equity risk premium plus size premium. As an example, suppose an analyst is valuing a private integrated document management solution company. The risk-free rate is 5%. The analyst estimate of the equity risk premium is 4.5%, and with the size premium of 4.35%. Thus, by ignoring any appropriate specific company premium, the estimate of the required return on equity, RI, will be 5% plus 4.5% plus 4.35%, which is equal to 13.85%. However, if the analyst estimated that the company will have a beta of 1.2 if publicly traded, based on a publicly traded peer group, the required return estimate would be 5% plus 1.2 times 4.5% plus 4.35%, which will get the answer of 14.75%. According to the estimation of the required return on equity for private business, the equity risk premium is often estimated with reference to equity index of publicly traded company. The largest market capitalization company typically constitute a large fraction of size of such index value. With a beta of 1.0 implicitly multiplying the equity risk premium, the sum of risk-free rate and equity risk premium is effectively the required return on an average systematic risk large cap public equity issues. In the great majority of cases, private business valuation concern about companies much smaller in size than public large cap issues. Valuators will often add a premium related to the excess return of small stock over large stock, reflecting an increment return for small size, which is known as the beta adjustment size premium. When the size premium estimate is appropriately based on the lowest market cap this year, the result will correspond to the return on an average systematic risk microcap public equity issues. Besides, an analysis of risk factors that are incremental to those captured by the previously included premia may lead the evaluators to add a specific company premium. Moreover, there are two additional issues related to the required return estimations for private companies. First is the considerations of the relative values of controlling versus minority interest in share value, and the second issue is the effect on share values of the lack of ready marketability for a small equity interest in a private company. Then, 4.3.2, we'll discuss about the bond yield plus risk premium. For companies with publicly traded debt, the bond yield plus risk premium, BYPRP method, provide a quick estimate of the cost of equity as the sum of YTN on the company long-term debt and the risk premium. For the YTN on the company long-term debt, it includes first a real interest rate and a premium for expected inflation, which are also factors embodied in a government bond yield, and second, a default risk premium. As an example, given a risk premium of 3.5% and IBM bond YTM of 5.632%, to calculate the cost of equity using BYPRP approach, all we need to do is to add them up and we will get the answer of 9.132%. Next, I will pass it to Chooi Yin to present the next slide.
I'm Chooi Yin and I will present 4.4, the required return on equity international issues. In a global context, issues that concern analysts estimating the required return of equities are exchange rates and data and model issues in emerging markets. First, we will talk about exchange rates. An investor is ultimately concerned with returns and volatility stated in terms of its own currency. Historical returns are often available or can be constructed in local currency and home currency terms. Equity risk premium estimates in home currency terms can be higher or lower than estimates in local currency terms because exchange rates gains and losses from the equity component are generally not exactly offset by gains and losses from the government security component of the equity risk premium. For example, the arithmetic mean UK premium over 1970 to 2005 was 6.58% in pound sterling terms, but for a US investor, it was 5.54%. The US dollar estimate more accurately reflects a US investor's historical experience. A sound approach for any investor is to focus on the local currency record, incorporating any exchange rate forecast. Next, data and model issues in emerging markets also concern the analysts. There are two approaches to supplement or replace traditional historical and forward-looking methods when dealing with difficulty of required return and risk premium estimation in emerging markets, which are country spread model and country risk rating model. Firstly, the country spread model states that the equity risk premium estimate for an emerging equity market equals to the equity risk premium for a developed market plus the country premium. The country premium is a premium associated with the expected greater risk of the emerging market compared to the benchmark developed market. It's often estimated as the yield on emerging market bonds denominated in the currency of the developed market minus the yield on developed market government bonds. For example, taking the approximate 13% yield differential between US dollar denominated government of Russia bonds and US Treasury bonds as the Russian country premium and using an estimate of 4.5% for the US equity risk premium, the Russian equity risk premium equals to 4.5% plus 13%, which is 17.5%. Meanwhile, the country risk rating model provides a regression-based estimate of the equity risk premium based on the empirical relationship between developed equity market returns and institutional investors' semi-annual risk ratings for those markets. The estimated regression equation is then used with the risk ratings for less developed markets to predict the required return for those markets. The next topic is the weighted average cost of capital. A company's cost of capital is often referred as the overall required rate of return of a company's suppliers of capital. It is usually estimated using weighted average cost of capital, WACC. The cost of capital is relevant to equity valuation when an analyst takes an indirect total firm value approach using a present value model. In this method, the total value of debt and equity is estimated by discounting the expected future cash flows available to debt and equity using the cost of capital. Then the value of equity is estimated by subtracting the market value of debt from the total value of debt and equity. The following slide shows the formula for WACC. In short, WACC is a weighted average of required rates of return for the component sources of capital. MVD stands for market value of debt, while MVCE stands for market value of equity. The tax rate used here is the marginal corporate tax rate. RD refers to the before-tax required return on debt, which is estimated using the expected yield to maturity of the company's debt based on current market values. Lastly, R refers to the required return on equity. A company's capital structure can change over time, and so is the WACC. Therefore, analysts often use target rates instead of the current market value rates when calculating WACC. These target rates incorporate both the analysts' and investors' expectations about the target capital structure that the company will tend to use over time. Target rates provide a good approximation of the WACC for cases in which the current rates may misrepresent the company's normal capital structure. The last topic is discount rate selection in relation to cash flows. When used as discount rates in valuation, required returns need to be defined appropriately relative to the cash flows to be discounted. Cash flow to equity is the cash flow after more senior claims such as promised payments on debt and taxes have been fulfilled. When a cash flow to equity is discounted, the discount rate used is the required return on equity. As for the cash flow to the firm, which is the cash flow available to meet the claims of all of a company's capital providers, the discount rate used is the firm's cost of capital. Furthermore, cash flows may be stated in nominal or real terms. When cash flows are stated in real terms, amounts reflect offsets made for actual or anticipated changes in the purchasing power of money. When discounting nominal cash flows, nominal discount rates are adopted, and when discounting real cash flows, real discount rates are adopted. In equity valuation, only nominal cash flows are used. Therefore, nominal discount rates are employed in equity valuation. That's all from us. Thank you.